So you expected cool. Was it cooler than you thought, Neela?
Look, I expected cooling goods sector. I did not expected cooling in services. It's because wages have been elevated and they're staying at accelerated levels. So we haven't seen a cool down in the labor market. And the Fed is pointing to 3.5 missing workers. Joe, what gets these workers back? Because the competitive pressures that are lowering prices in the goods sector are working in the opposite way in the services. There is still demand for headcount, and firms are competing with each other, which is raising wages. And that's the issue before the Fed when it meets on Wednesday to really make a decision.
And Tomas, do you think that is a long-running issue, or is it still a one-off from emerging from the pandemic? Is this deeply ingrained in the labor market now?
Well, I think there's kind of several deflationary measures that people kind of don't talk about a lot that is coming in. I mean, we have a month-to-month now of 0.6, 0.6, 0.3, and 0.1 in core, which is very, very good, obviously, but there's sort of some deep deflationary pressures out there, I think. Obviously, the money supply, which people don't talk about at all, but if you think about money supply with lags, that's exactly what's going on with the explosion 2021. Then we got inflation, and now we have inflation coming down because money supply is completely dried up, obviously, a year ago. So I think that's one. The second is, you know, this peak of this excess wealth that consumers, we had a huge income growth in COVID, more than any boom, essentially, if you look at disposable income. That income is now dissipating, obviously. We're, you know, 1.5, 1.4 trillion in extra save. That runway is coming off now because people are in real spending going up and real wages going down. That can't continue. So that's coming down. And then you have some supply measures that the government put in to stop labor supply, or, you know, not shut down, but limit labor supply, I should say. The main one in dollar amounts is the Medicaid subsidies that went out in the middle class so that people didn't need to take a job to get health coverage. And those are kind of running off too, which put downward pressure on prices once we get labor supply out as well. So I think those forces are encouraging. I think the wage forces in the last few labor reports are discouraging, obviously.
Oksana, I hope you weren't just dying to get in there with something really unbelievable. That's what I'm expecting from you. What do you think?
Well, I think there are two really important issues here for investors, right? No matter how tough the Fed has talked up until this point, the market has largely disregarded it and continued to ease financial conditions, continued to rally. And today we have a number that is giving the market a real reason to rally. And so the two questions for me are, number one, do we get potentially another spike because financial conditions ease enough where we get another acceleration to the inflation number at some point in 2023, causing the Fed to go farther than is currently estimated? Because the market right now is not even pricing in the distance that the Fed is telegraphing it's willing to go. And the second issue for me is, where does inflation actually moderate, at what level? Because I don't think that's really priced into market action at all, meaning having to live in a world where the cost of capital is between 4% and 5%, let's say, for some extended period of time, for a year or longer than a year. What does that do to corporate balance sheets? What does that do to profit margins? And of course, with wage pressures continuing to be strong, with the consumer continuing to be resilient, you know, this makes the Fed's job quite difficult. But I think investors have to ask themselves, what is actually currently priced in? And I don't think any of the things that the Fed is telegraphing, the fact that they want to get to a real positive rate, and they're still far away from it. And not only that, they want to be about a 0.5 percentage point more restrictive than the real, you know, neutral positive rate. Let's say it. None of this is currently priced into markets, and that is what's concerning to me.
Okay. Cameron, I wanted you to be able to have, hold on. I want you to be able to have, Cameron, all this info before you decide what to do, because we're going to come to you for what to do with the stock market. Now, you've heard all that. You've been pretty bearish, and you really think the Fed's going to have to go much further. That was already up back in a bull market. Does anything change your mind here? Are you still a seller?
Well, it's not necessarily just the destination, it's the duration of how long that they stay tight. And if we look at what the bond market is pricing in, it's a really rapid shift to rate cuts starting in the second half of 2023 of about 50 basis points, and then a full 200 basis points by the time we get to 2024. And given the fact that we're still seeing some of these underlying inflation drivers be tight, core services ex shelter still came in at 6.8%. And that's about in line with where we're seeing with wages. Atlanta Fed wage tracker is still running at 6.4%. That kind of environment does not support the Fed pivoting to cuts in very short order, which means upward pressure on yields and likely downward pressure on valuations for the equity market.